Hello folks, in the next 10 minutes, I'm going to show you the four-step framework, how you can become a profitable trader in the next 30 days. Or at least you're going to set yourself up to become a profitable trader. So let's get started. The first step is the market structure. If we draw a pie and let's assume this is a technical analysis, I would just divide it into two pieces. The first one is going to be, we have to know the direction of the market, where the market is going to go. So this is literally going to tell you where the price tends to go. And this is the first half of the pie. The second half of the pie we will cover a little bit later. But let's first talk about the market structure, about the market direction. What is this? Let's imagine you kick a ball. The ball flies in one direction, and then after it falls down to the ground, it continues going into that direction for a couple of meters more. So the same is true about the price. The banks, institutions, I don't know, whatever you call them, they set up the price. They place big buy or big sell orders, and those big orders have an effect on the price that set up a new trend. So for example, here probably we did have some big buy trade from the big institutions, and that big buy trade just drove the price to the upside. So price went to the upside for some considerable amount of time. And that price action exactly called the trend. And the trend can be read, can be identified actually. So we can read the trend by the market structure. Let me explain you the market structure in simple words. This is where the price is making a consistent pushes and pullbacks into one direction. For example, the price might be going to the upside, but price never goes this way. It always makes the push, pullback, push, pullback, push, pullback. So if we do have the pushes to the upside that are higher, that makes the higher highs than the previous one, that means we are in a uptrend, and the vice versa is true about the downtrend. If price makes a consistent bigger pushes to the downside, that means we are in a downtrend. So guys, and there's the second state of the market when the price is not moving anywhere. That is called the rangy market. So literally guys, if you're able to read this kind of structure, you will be able to identify where the market is going. This is the first step that you have to master, and I do have the whole video explaining the market structure. I will leave the link in this video. So guys, we've talked about the pie. How does the technical analysis work? And if the first half is the market structure, the second half is to be able to enter and exit your trades, finding proper entries and exits. So literally, even if you know where the price is going, it's going up or down. Like for example, you see the price, the trend is clearly down. How can you trade it? This is where the finding the proper entries and exits are going to help us. Because if you don't know how to enter and exit your trades, you will simply be taken out by the price. For example, let's imagine the price made push, pullback, push, and you're seeing that it is on an uptrend, and you have identified probably there were some price action. You have identified some imbalance or order block or support and resistance, and you've placed your trade over here. The price might simply sweep your trade, sweep your order, and then continue going in that direction. And in this case, guys, there are hundreds and hundreds of tools like support and resistance. You can use the FIB levels, you can use the order blocks, you can use the supply and demand zones. All of them are considered to be considered to be the tools that are focused on finding the proper entry points. So this is where you have to identify what works for you, because there are different types of analysis, different types of trading. You might be the swing trader, you might be the position trader, you might be the scalper, you might be the day trader. All of those people have different tools, because different tools for entries. Some people use, for example, the EMAs. For example, I do use the EMAs, 200 EMA, to define my direction. But some people use the crosses of the EMAs to find their entries. But I will tell you a better way to identify your entries if you want to become the day trader, scalper, or even a swing trader. So guys, we know where the price is going. We know about the market structure. We know about that we have to identify the proper entry and exit points. And the third step is simply, I want to tell you what is going to be the better solution for finding your entries and exits. It is sort of like the combination of the market structure plus some just tools for your entries. And that is trading the patterns. A lot of people get it wrong when they try to identify their proper entry and exit points, because we are, as a human beings, logical creatures. Everything that has a cause has an effect, and we live in a rational world. When you do have an action B, after which should be the action C, etc. And so we think linear way, but the markets are a totally different place. It's a game of probabilities. Here you cannot justify the movements of the market. This is where the trading the patterns comes into the place. Even though we cannot just predict what is going to do, what is market is going to do, but we can identify the patterns, that the market repeats over and over again. Again, these patterns are not going to have 100% win rate. And in a minute, I will tell you the 3 best patterns that I found for myself over 7 years of my trading experience. But a little more about the patterns. So you have to think about the patterns this way. Just imagine a box, and there are 100 balls. 50 of them are green, 50 of them are red. And you just pull over one ball at a time, and you don't know what is going to be that ball, what is going to be the color of that ball. Is it going to be red or is it going to be green? Let's imagine the green is win and red is loss. You don't know what is going to be your next trade, the outcome of your next trade, but you know for sure that if you make 100 tries, 50 of them is going to be red and 50 of them is going to be green. So this is how patterns works. And let's talk about exactly what patterns you can trade, what patterns you should focus on. There are 2 market conditions: when the price is, for example, it is trending, and when the price is simply ranging. So when you see a trend, the first thing that you can trade is the breakout and retest. For example, always when the price makes a higher high, higher low, the next time it is going to break out through that high or low and then come back to retest something inside of this push that happened. And this is called the break and retest, the continuation pattern. There are lots of continuation patterns, guys. This is sort of like the segment of trading. It's called like trading the continuation patterns. The second type of patterns is trading the reversal. You might think to yourself that continuation patterns are sort of like the same as the reversal patterns, but no, the trend might get a little bit complex. For example, at some point price reverses from one trend to another, or there's such a thing as, for example, the price is in the range like you see here, and above the price and below the price we do have some price action above and below. So the reversal pattern is simply when the price is breaking out from this range and then retesting some level that was outside of our range, and then price reverses. This is exactly how does the reversal patterns works. And the last one is manipulation pattern. Manipulation patterns most of the times works when the trend gets exhausted or when the price is rangy. For example, you see a lot of time this one. For example, the price is going in a trend and then goes up, fails to make the valid breakout, and then just reverses completely into the other trend. So this is exactly how does the manipulation works. Or just imagine the price is just rangy, it's not going up nor down. So price always manipulates either the higher border or the lower border and then reverses to the other side. This is called the manipulation trading, and there are hundreds of patterns that you can use to trade the manipulation. If you focus on those 3 patterns, you're gonna make it with trading. I just promise you. And if you want to learn exactly what patterns, what continuation pattern, what reversal pattern, what manipulation patterns, I would suggest you to try out the OP investing methods. OP investing methods are simply the 4 patterns that we use on the 15-minute time frame. Those 4 patterns cover all of these 3 just sections of trading patterns. There is the OP method number 1, which is focused on trading the continuation. OP method number 2 is focused on trading the reversal. The OP method number 3 and 4 is focused on trading the manipulations, and it is focused on trading the manipulations around the key levels, around the rangy market and around the reversal points, around the key reversal points. So I will leave a lesson, a webinar, 1 hour long webinar. There is going to be the link in the description. You can go and watch it. And plus, at the end of this video, I will just link up one video where I will tell you more about the OP investing methods. So guys, in our framework, I told you that there is going to be 4 steps. The last one is the risk management, or being consistent. Let's tell it. Being consistent is very important. Like, no matter what you do, is it going to be about your risk you take, or is it going to be about the patterns you trade? It's literally, just imagine, again, the same example of the box. Imagine the box is your strategy that you choose. If you start pulling up the balls from one box, and you imagine like the second, third, fifth, 10 trades straight, you're getting the red balls. But it has nothing to do with you, because it's not your fault. You're not doing something wrong. It's just a part of the plan, because you might take 10 losses, but the next 20 trades might be profitable. This is how trading works. This is why, if you want a predictable outcome with your trades, if you want a predictable results, if you want a consistent results with trading, if you want to become a consistently profitable trader, you should stick to one trading strategy for a reasonable amount of time. For example, you took 100 trades, 200 trades, and if you're not profitable, probably you should tweak something, you should change your strategy, do anything about it. But if you took only just, traded with your strategy for 1 month, it does not prove anything. This is why it is so important to learn from someone. who already have the proven strategy, who already trades with the one strategy for a considerable amount of time. So the next one is being consistent with the risk that you take. For example, if you're going to risk 1% here and after that you're going to risk 10% on the next trade, just imagine you won the first trade, you've made 3R and you've made like 3% return. And the next trade you've got overconfident and you've risked 10% on the trade, and that one was a loss. And you literally lost one trade, won one trade, and you're down 7%. But in reality, the first trade you won, that was 3%, and the second one was loss, that was minus 1%. So literally, you should have been up 2%. This is how the risk management works. And if you want to have a consistent growth, consistently grow your equity, grow your account, pass funding challenges, grow the capital under your management, you should be able to stick to risk management. This is everything, guys. And guys, this is the end of this lesson. I hope you liked it, and make sure to subscribe, leave a comment down below, and make sure to go through the link to watch the 1 hour long webinar. Thank you.